Hi everyone, how are you today? This is Andrew with Invested. I'm one of the advisors there, and today we'll be presenting this intro to investing presentation for you. A little bit about myself. I have been with Invested for almost 2 years now, and I carry the Series 65 license. Invested three pillars of existence are the free financial education, which we accomplish with presentations like this, in-house seminars. Obviously, not at this time. We actually just moved all of our services online now. Like no more in-person meeting, at least for 2 or 3 weeks. Everything over the phone. All our presentations will be changed into webinars now. So follow us online, and you will find more information, very helpful information regarding to this period of time that we are going through. And as I said, the first mission was to educate people. We strongly believe that with the right education, people will do the right choices in the future, especially for times like this. And then we offer the free financial planning piece, followed with a free meeting. And then we can talk about anything finance related. And whenever you become a client, the free financial planning is incorporated to the fee that you already pay for the asset under management. And then obviously investments, we handle investments, but that's like a side effect of what we offer first. Again, we are really focused on the education piece because we want to educate everyone as far as everything related with the finances. Our parent company, to go a little bit back in the story of Invested, our parent company helps and has been helping high net worth clients for almost 20 years now. It operates as a family office business, and then we were kind of like, we wanted to change actually the mission, like why we are helping only people that already have this information. They have access to this information. How about the rest of all us? Why don't we spread this information with everyone else? And then how we did that? Well, again, by educating, giving free education, followed by a free meeting, and also we waive the minimums. What does it mean? In order to work with a registered investment advisor, you have to have already to invest $250,000, if not $500,000, ready to invest investable assets, not your house or other things. So why we are still helping those that already have a chunk of money? So that was the idea of Invested. That's why we were created, because by waiving the minimums, we help all the rest, which they want to get there, but who will work with them? You can start with as low as the minimum transaction with us will be $10. So again, it's not about chasing or focusing on just on the investment or the money piece, but we are focused on creating habits, creating good habits. How does it start? By being educated, okay? And then I will mention it again, we are a registered investment advisor company. That makes us, which means we are fiduciaries. It's a big difference between a fiduciary and a broker. A broker technically can give you financial advice, but is that the best as far as on your behalf? Is that the best advice? I don't know, because a broker has a parent company which it has he or she will have to be loyal because they generate commission. So again, it's a big difference. It's a big difference between being paid, being a commission-based paid, and fee only. We are fee-based advisors. That means that you will pay a fee only for the assets under management, the assets that we manage. Okay, no other parent company or or any interest that we need to sell this product to a client because of this or that. No. Oh, the only thing that we have is the advice. Okay, so you pay for the advice, and that's better, meaning that that's a payment structure, because again, as I said, whenever commissions are involved, people tend to be a little bit more salesy. All right, with that said, I want to kind of like a quick household here with a platform. On the right side of at least of my laptop, I have this chat box. I put in my email there, and please follow us at mdinvested.com. You'll find us in social media, Facebook, Instagram, and you can look up our page and see a little bit more about the team or the services that we offer. If you have any questions, please feel free to text me anytime on that chat box, or at the end, I'll leave a few minutes for questions that you might have. So feel free. Also, you have my email there. And lastly, please schedule a free meeting with us so we can discuss more in depth about your situation. All right, so intro to investing is a very light topic, meaning that we're going to talk about things that we need to know before we jump into investing. You know, very important and basic actually things like what is a stock, what is a bond, what is compounding interest, when do I start, how do I start, you know, things like that. So let's start with what is investing. Investing is making priorities for your money, financial future over present desire. What does it mean? Like, in order for us to get to a goal or to multiple goals, we need to do something today, because goals might be in the future. Usually they are, you know, it can be in the near future, in the later future. So again, we have to prioritize things. What is more important for us? Letting your money work for you. Okay, whenever you mention the word investing, money should work for you, not you working for the money. It's a long-term strategy, is not a short-term fix. Okay, whenever you need or you have a short-term goal, a year from now, 2 years from now, please do not invest that money. And actually now is the perfect time to kind of bring that as an example. If you would have invested, I don't know, 3 months ago, and then the market went down, then and you need the money, then what would you do in that case? So again, have your emergency fund in place first, goal number one, and then anything after that, it depends on your goal. You can invest, you can put it toward your retirement, toward extra debt payment and things like that, but have your emergency fund. Do not invest money that are meant to be kept in cash. Okay, and in cash, I don't mean any paper cash, but in your savings account, in your checking account. Things to consider before investing. Well, you should evaluate your financial goals, risk tolerance, and time horizon. So when is the goal going to happen? Like, what is that? Is that your retirement? Is that 10 years from now, 20, 30, 40 years from now? Your risk tolerance, like how would you act in a scenario like this now, like 20, 30% drop? Would you feel stressed about it? Would you put more money? Would you sell, freak out and sell? Or would you just, you know, don't pay attention, just stick with your goal? Maybe increase a little bit the contribution on that retirement account or whatever it can be, early retirement. Investment vehicles, investment vehicles that work for you based on the above. Like, what do you have available? Do it yourself versus professional guidance. Now, there's nothing wrong to do things on yourself. Absolutely. Just keep that in mind, that you are doing certain things with maybe a doubt. Like, did I do it right? Did I put in the right fund? Or am I doing the right thing, basically? Like, am I saving enough? If so, how much should I save? And things like that. As everything else, it requires time. So again, priorities. If you need more time to do on what you are good at, then it's nothing wrong to delegate things. However, if you need help investor will be very happy to help you with that. All right, let's actually talk about what is a stock, what is a bond. So a stock shares in the ownership of a company. Investors have the opportunity to be shareholders and participate in the growth of the company. All right, so you basically become a shareholder or an owner with the company in a small fraction, of course. So it depends how much stocks you buy, what's the value. Bonds, consider that as you, the investor, are the lender, and the issuer is the borrower. So the company, it can be a corporate, it can be government, municipal, so it can be different type of bonds. However, you won't be able to go directly to a big corporate and say like, hey, I have this money I want to lend to you. No, you'll buy a bond fund, or in your portfolio, you just put some funds in it. I'm sorry, some bonds in it, and that's how you become a bondholder. Sorry. So just to explain a little bit further, if something happens to a company, bonds have the right to be paid first. Stocks, you don't have any guarantee at all. Bonds are backed up with the asset that the company has. What is a mutual fund versus an ETF? I'm sure if you have a 401k or a plan for your job, 403b, you have heard the word mutual fund. ETFs are kind of more a newer thing maybe for some of you guys, for some of us. However, the difference is that they're very similar, okay? The difference is that a mutual fund trades at the end of the day, at the market close, while an ETF, exchange traded fund, trades as a stock, okay? As you see here, bought, sold, like an individual stock. Like you see that price, you sell it or you buy it, you get that price. With the mutual fund, whenever you sell a mutual fund, they will say like, hey, keep in mind that you will get the price of whatever is at the end of the day. It might be higher, it might be lower, okay? So a mutual fund is a pool of investors, money invested in various, in different securities, stocks, bonds, and determined by the fund prospectus, by the fund goal that they have, the managers. An ETF, similar to mutual fund, but generally invests in a specific index such as S&P 500, Dow Jones, Nasdaq. So it follows an index. It just tries to mirror an index. It's more like a passive type of investment. S&P 500, I'm sure that you have heard about that too. Standard & Poor 500, the composite index of the 500 largest publicly traded companies. All right, whatever you can imagine in US, the 500 largest, biggest company, that is the composite of the S&P 500. It is one of the most widely quoted indexes when people refer about the market. That's what they're basically talking about, S&P 500, Dow Jones. Okay, these are the most known, but however, there are thousands of index funds out there. Active versus passive investing. So to be clear, the word passive, not necessarily, it might sound like not a very good thing, like as active might sound, it is not actually something that you don't want to do, because what it means is that it is just a fund tracks or try to mirror an index, such an S&P 500. Okay, they don't try to, beat that. As far as they get the same return as an index fund, and passive investors are really happy. Usually the case is with the ETFs. Okay, minimal turnover, so they don't buy and sell excessive times their portfolio, their stocks. typically low in fees or expense ratio because of, again, there is no manager, there is no turnover, so it doesn't generate any taxable income, it doesn't generate fees to pay because managers, they need to be paid, obviously. It's more like a buy and hold. Okay. Hands-on, as far as active, I'm sorry, uh, hands-on approach aims to outperform the market. Active management, they try to beat the market, but guess what they're doing? Anyone can guess? Exactly, taking more risk. Exactly, yes. So what they're doing, taking more risk. Me as an advisor, if I can get someone to their goals, to achieve their goals with less risk, obviously I'll take that. I don't need double-digit return. As if we run the numbers and we see that if we do the right things, save with a specific saving rate, like no need to take extra risk because obviously higher the risk, higher the return, and vice versa. Typically higher fees, expense ratios result because again there is a manager and there are all type of different fees. Compounding interest, also known as the interest on interest. So basically, is the interest calculated on the initial principal and also on the accumulated interest on the previous period of the deposit. So basically, you would put $100, 8% return, for example. At the end of the year, you have $108. The next year, you will get 8% of not the $100, but the whole $108. So obviously, it will be more the second year, and so on, compounded in 10 years, 20 years. It is a big difference. Rule of 72, you can Google that. With a 7.2% rate of return, which is totally normal in this industry, at least according to data, last 100 years of data. Regardless of the ups and downs of the market itself has been returning 7%, 8 around that. So again, in a portfolio that you get that type of return around 7%, rule of 72, your money should double in 10 years. Now, $1,000 will be $2,000 in 10 years. But if you add more, if you save, then obviously that will be even faster. So keep that in mind. Compounding interest will help you a lot until to a certain point, but if you add to your investments, obviously you get to your goal even faster. So that's why we're not just focused on the investment strategy, but we are focused on the holistic picture of financial situation. Like, yes, we're investing, we're doing the great thing, the right thing, but are we adding on it? Are we, at least we shouldn't withdraw from that investment fund in order to double our money. But again, if we save, if we budget in the right way, things will get really smooth and faster. Let me explain the compounding, the power of compounding. As you see here, let's assume the investment growing 8% per year, $10,000 investment annually. This is just for illustration purposes. But again, as I said, 7-8% is pretty common in this industry. So $10,000 a year invested annually, each year. If we did, so let's say today we talk about that, but we wait 10 years because we want to wait for the perfect day to invest. This is a perfect scenario, with the market fluctuating every day. So someone said like, oh, I think the market will go down, so I'll wait. Okay. And then that person waited 10 years. And then instead of investing, in a 30 years span, he invested only 20 years because he waited 10 years. He or she will have $457,000. Okay? If that person, she or he, decided to wait only 5 years and then jumps and invest same exact amount of money, $10,000 annually, same return, 8%. After 25 years, $731,000. Okay? If that person, we talked about that, and that person decided to invest today, same amount of money with the same return, look after 30 years, how much we'll have? $1.132 million. So we'll have $1,132,000. So it's a very big difference, more than double, but just 10 years. It's not double of time. It's not 20 years plus 20 years. No, it's 20 years plus 10, but the return is more than double. So what does it tell us? The power of compounding. Okay. All right. Another interesting fact is to kind of see, like, saving. It is great, but how is saving and investing related? Like, is it good just to save without investing? I don't think so. Saving basically without the investment piece is like a kind of half process. We need to combine them together because, and so the saving definition is money in storage. They don't actually grow, and especially now is a perfect case to come up with actual examples. So far, we had some online savings accounts. They were given up to almost 2%, sometimes even a little bit over that. But now with Feds cutting rates, I think barely, even like with those online savings accounts, can get like maybe 1%, if so. And your local bank will give even less, might give like a 0.01% of interest. So basically, in any amount you are keeping in the storage without investing, you are not making any money at all. Now, let me be clear. As I said before, everything that is for your emergency fund shouldn't be invested absolutely, should stay in that savings account. Well, obviously try to look at the best saving account that will give you some money back. Absolutely, that's totally fair, but absolutely not invested. So that's fine to be kept into cash, into a saving account. Investing, as a definition of investing, long-term ownership. Okay, if you invest, that means that you are planning to have that, to keep that investment for a long term. Types of saving, savings account, CDs, or checking account. You can, keep that money there because you need them for everyday transactions or for an emergency, for a rainy day. Type of investing, stocks and bonds. Returns with the saving, obviously they're minimal because the risk is low. They are insured up to $250,000, FDIC insured, with this online or local banks. Returns, if you invested, low to high, and risk low to high. Okay, keep that amount in mind, that whenever you invest, you carry a market risk. It's not such thing as guaranteed from any bank. Asset classes. Okay, group of investment with similar type of characteristics. Stocks, share of a company ownership. Bonds, corporate and government debt. Cash, as we said, checking, savings account, and treasury bonds. But those are things that you won't have easy access to that. So again, you're still going to rely on that fund, a bond fund, a stock fund. So again, just to have them clear. So we have, if you are investing, what actually are you invested at? Mostly stocks and bonds. Okay, cash. I think mutual funds, they need to keep a certain percentage in cash. So what does it mean? That money is not generating any income for you. But I think mutual funds by law have to keep a certain percentage. All right, so now let's talk about the difference between a broker dealer versus a registered investment advisor, which I mentioned at the beginning. Examples of broker dealers, we have Merrill Lynch, T. Rowe Price, Morgan Stanley, Goldman Sachs, and other names. Registered investment advisors, invested or other RIAs. So make sure that you ask for that R. If you are working with someone, ask them, are you registered? Because the term investment advisor is heavily used from broker, dealers, and actually advisors, registered investment advisors. But they are, and they have to by law tell you if they're registered or not. Standards, a broker dealer will do what is suitable for you, what is okay, but not necessarily the best. A registered investment advisor standard is fiduciary. Okay, by law, we have to act in your best interest. Okay, product price, it is, in case of the broker dealer, it is determined by the parent firm, best product at the firm's price, obviously, whatever they offer. If you're working with registered investment advisors, lowest price available, obviously, because again, they have your best interest. First, loyalty. A broker dealer has to be loyal to their parent firm, obviously. If the firm has a fund and they have to, sell or offer to clients, obviously they won't offer a fund from another company. They will offer their fund. Is that the best? I don't know. It might not, because again, not having other, opportunities available, that tells me that I don't know if I'm getting the best deal out there. I don't know if I'm getting the best product. Okay, no competition. Loyalty as a fiduciary client, obviously. How are they paid? Commission paid by third parties. That's where the interest started kind of like getting skewed a little bit on the, I don't know, in their side, I'm guessing. Okay, whenever you get a bigger commission, you are more prone to not have the best interest when it comes to your client. And registered investment advisor, fee paid only, advisory service. So again, the only product a registered investment advisor has is the advice. Okay, so keep that in mind. So that's why it is easy for a fiduciary to do the right thing, because by law is constricted to do the best for the client. Risk tolerance. Whenever you invest, you just keep this in mind. Low risk, low return, high risk, high return. Okay? So it sometimes is kind of like they go along together. Yes, you want to make double digit or more return. Guess what we have to do? You have to take more risk. What is diversification? Diversification is spreading out your investments and limiting your exposure to one type of security. Okay, and then there are different types of diversification. Large cap, so large companies. You have some stocks there. Like if you have a portfolio, you have a 401k, for example, or you're not an IRA and you buy a index fund, or that fund or that portfolio has or should have large cap stocks, so large company stocks, medium-sized company stocks, small company stocks. So that's a diversification. On top of that, they might have US stocks, European stocks, Asian market stocks, emerging market stocks, so countries that are developing now. So again, that's being diversified, not just in one place, and absolutely not just one type of stock. That's actually when it starts getting really risky. As an example, if you invest in a stock and a bond portfolio and the stock market crashes, you only see a drop of the money on the stocks portion, okay, on the money you invest in stocks. So you basically see the drop on the stock portion, not the bond. Now, also bonds, they fluctuate with the interest rate, but not as volatile as stocks. Okay? When should I start and how much? When? Well, as early as possible. Okay? Remember, it's never too late to start though. Keep that in mind. It's never too late to start. Average age that people start investing is 35. That does not mean that you have to wait until 35. Absolutely not. As soon as you can, as soon as you have information, as soon as you have the vehicles and tools to do that, please start. But again, if you are at around 35 or older, keep in mind that this is the average you have, friends. How much? Anything above zero is good. Anything you can. Even small amounts will grow in the long run. The golden number is 20% of your income that goes toward paying yourself. That does not mean buying nicer shoes or clothes. That means that you put money towards saving, investing, paying off extra debt, and not just the debt that you might have, like a mortgage, for example, the principal and the interest part. Not just that. That is an essential. You need to pay that. I'm talking about extra debt. But again, pay yourself does not mean treat yourself. It means put 20% toward savings, toward retirement, toward investing. So that's the golden number. But again, anything above zero is good. Investment vehicles and strategies. Well, as far as vehicles, 403b, 401k, through your job, if you have access to one or if you work and your employer offer one. IRAs, anyone can have one as far as they have earned income. Or anyone can have a taxable investment account. All right. The only downside is you have to pay taxes on dividends at the end of the year. While in a retirement account like 403b, 401k, IRA, you don't have to pay taxes because they're retirement accounts. Strategies, diversify as much as you can. Try to keep your cost low and manage your behavior. That's very, very important. You should know when to, you should, like, whenever you start investing, adjust your expectations. If your goal is 20 years from now, or 10 years from now, or 30 years from now, it does not matter what the market is doing. Actually, I am sure that a lot of people are so worried about the market, what it's doing now, but this is the prime time, honestly. This is the Black Friday of TV, of anything that you want to buy on Black Friday in stock market. So again, that's why I mentioned if you have short-term goals like emergency fund or money that you are supposed to travel in a year, do not invest that. If there are long-term goals, 10, 20 years from now, it is totally fine to be invested and you shouldn't be worried. What you can do is dollar cost average, which I'm sure if you have a 403b or 401k or an IRA and you're putting money every paycheck, you are already doing that. What does it mean? You are buying, especially now, way more shares with the same amount of money that you are being taken away from your paycheck to invest. Or let's say the employer is, sometimes they match. They put a 3% and they require you to put another 3%. So that's 6% of your salary, which is the same, unless you get a raise, is buying more shares now that the market is low. And obviously less shares when the market was up. So if you do that in the long run, it will turn out in a better cost average, okay? Instead of someone waiting for the best price. I don't know when the best price is going to be, honestly. It can be, tomorrow. It can be after a year. Like, I don't know what the market is going to be. When the first day dropped 3%, a week ago, and then I saw people selling, and like, oh my God, why don't you wait? Well, it can go like even lower, and then guess what? It went lower, and then they didn't lose as much. They lost only 3%. So again, there is no such thing as the best time to buy or to sell. And to give just an example, okay? All right, so in all this, how investors can help? Well, or who is investing? That's the trusted partner to simplify, educate, support, and help you achieve your goals. We use a sophisticated and secured online platform. We use Betterment as our custodian. Um, it, it is so simple to use. That's the only reason why we use that. And by law, we need a custodian to hold the assets. We are not allowed to hold assets. Low flat advisory fee, which is less than 1%, 0.95. That's an example. There are no minimums to start investing with us, but that's an example. You invest $1,000 with us, your fee will be $9.50 per year. That includes the investment fees, the ongoing relationship, cash analysis, free financial planning. It includes the financial planning. So anything that can arise later, finance related, you can talk to us. We'll be happy to look at it. Or let's say you invest just $100, not even 1,000, and you have other assets. You have a house and other assets, and you want to talk with us and get an advice. We still will advise you even on those assets which are outside of investing. So you get a whole net worth management with just whatever portion you decide to invest with. You don't have to write us a check. It will come from your investment portion. So no other headaches. It has an automated savings and investment process. You link your bank account, and then you decide to, invest a certain amount of money every 2 weeks or a month, every month, and then you don't have to think anymore about that. All right, as an example here, how invested is different from other broker dealers or other advisors or online robo advisors. Like you see Betterment, if you use Betterment on your own, their fee will be 0.25, but you don't have a person which you can ask. You're going to be just the platform you trying to figure out. And absolutely, anyone can do that. Just again, we should bring at least 1% value in your life in order for someone to work with us. As a fiduciary, we should be very transparent and show you how we can help or bring value in your life in order for someone to decide to work with an advisor. Our fee, the 0.95, includes everything. So Betterment is included there, even though we use Betterment's platform, just to be clear. Again, keep in mind, even if you don't work with Invest in the Future, make sure the person you're working with is a fiduciary. It is very, very important. Well, I really thank you for taking time and being here with us today, wanting to learn more about investing, wanting to learn more about how to get started. We'll be happy to answer your questions. Sorry. And I will stick around for a few minutes. However, I left my email there. If you have any questions, you can email me. But as I said, feel free to schedule a free one-on-one meeting, especially now that we are offering only virtual meetings like over the phone, Skype, Google Voice. You don't have to even come to our office. You don't have to park or do anything. Just we schedule a phone call and will be easier. If you'd like, I can send you our newsletter with our upcoming events. I know we have tomorrow a budgeting basics at 1 p.m. It is a very interesting presentation also. Also, I want to mention something that our marketing team is doing now. For every person that completes a meeting, they enter in a raffle to participate in I think it's a $200 gift certificate for Oysters Thames Street in Fells Point. It's a really nice place, really nice restaurant. All right, guys, I'm gonna make sure that, all right, my email, follow us. If you don't have any questions, I really thank you for taking time and being here with us today. Um, Keep an eye for our future presentations. As I said, tomorrow we'll have budgeting basics, and I think taxes on Wednesday. We'll talk about taxes. Thank you again. Be safe out there. Try not to get out.